Why smart people stay poor. It's not what you think. The assumption that costs everything. The biggest financial mistake isn't being bad at math. It's believing that intelligence automatically creates wealth. You know someone like this. Maybe you are someone like this. The person who reads everything, understands everything, can explain compound interest at a dinner table with more clarity than most financial advisors, knows exactly what an index fund is and why it outperforms actively managed portfolios over every meaningful long-term period, and has known this for years. They can tell you the difference between a Roth IRA and a traditional one, why the 4% withdrawal rule works, why the average car lease is a structurally poor financial decision. They know it all. And they are broke. Not dramatically broke, not can't pay rent broke, just quietly, persistently, inexplicably not building anything, the specific kind of broke that's almost harder to explain than the regular kind, because all the knowledge is there and none of the results are. This is the paradox nobody talks about. Intelligence and financial success are far less correlated than everything you've ever been told implies. And understanding why, understanding the specific, predictable, deeply human mechanism that keeps smart people poor is the beginning of the only financial education that actually changes something. Why IQ has almost nothing to do with wealth. There is a version of this conversation that starts with statistics, and the statistics are genuinely striking. Studies on financial outcomes consistently show that above a modest baseline, higher cognitive ability does not reliably predict greater wealth accumulation. Some of the most financially sophisticated people in the world have gone bankrupt. Some of the wealthiest people alive dropped out of school or struggled academically. The correlation between measured intelligence and net worth is weaker than almost anyone assumes going in. But the point is the mechanism. Why does intelligence fail to produce wealth so consistently, so predictably, in so many otherwise capable people? Because wealth is not an intellectual problem. It is a behavioral one. The knowledge required to build financial security is not complex. It fits on a single index card. Spend less than you earn, invest the difference automatically, start early, don't stop. That's it. There is no hidden formula. There is no insight that only reaches a certain IQ threshold. The information is free, widely available, and has been for decades. What is difficult is not understanding it. What is difficult is doing it consistently, quietly, without an audience, across years of ordinary life where the temptation to spend, upgrade, and perform is constant, and the reward for not doing so is invisible until it suddenly isn't.
The behavior gap. There is a term in behavioral finance called the behavior gap. It describes the difference between the return an investment earns and the return the investor actually receives. And the gap exists almost entirely because of decisions made during moments of emotion. The market drops, and the smart investor sells, locking in a loss. The market rises, and the smart investor buys more than they should, chasing what has already happened. Both decisions feel logical in the moment. Both decisions destroy value systematically and predictably. The smart person is not protected from this. In some cases, they are more vulnerable to it because intelligence produces the ability to construct a convincing argument for almost any decision, including the bad ones. The smart person doesn't panic and sell randomly. They panic and sell with a thorough, well-reasoned explanation for exactly why this time is different and why the rational move is to get out now and re-enter at the bottom. The bottom, of course, is only visible in retrospect. The explanation, however thorough, was the emotion wearing a suit. This is the behavior gap, and closing it has nothing to do with knowing more. It has everything to do with building systems that remove the decision from the moment of feeling entirely. Emotional spending and the intelligence trap. Smart people spend emotionally for the same reasons everyone else does. The difference is that smart people are better at explaining why their emotional spending was actually rational. The expensive dinner wasn't indulgence, it was networking. The new laptop wasn't an upgrade, it was an investment in productivity. The car lease wasn't status, it was reliability, and the tax write-off makes sense when you run the numbers. Every purchase arrives with a built-in justification, and the smarter you are, the more sophisticated and convincing the justification becomes. What is actually happening underneath the justification is the same thing that happens underneath everyone else's spending. A feeling is looking for a purchase. Stress, boredom, the specific discomfort of a difficult week, the desire to feel like the income is producing something visible. These are not uniquely unintelligent experiences. They are human experiences, and intelligence does not immunize you against them. It just gives them better packaging. The fix is not smarter reasoning. The fix is recognizing that the reasoning itself is the symptom, not the solution. When you notice yourself constructing a sophisticated argument for why this particular purchase actually makes financial sense, that is the signal. The sophistication of the argument is the red flag, not the reassurance.
Lifestyle inflation and the moving ceiling. The raise comes. The smart person knows exactly what they should do with it. They have read the books. They understand the math. They know that routing even half of the raise into an automatic investment before the lifestyle adjusts to receive it would compound into something significant over the next decade. They don't do it. Not because they forgot, and not because they don't care, because the lifestyle adjusted first. Before the decision was made consciously, the apartment got a little nicer, the grocery budget loosened, the subscription tier upgraded. None of it was dramatic. None of it required a decision that felt like a decision. It just happened, the way water finds the available space, and by the time the conscious mind arrived to make the intentional choice, the raise was already absorbed. This is lifestyle inflation, and it does not care how smart you are. It operates below the level of conscious decision-making, in the automatic adjustments that a life makes when income increases and no structural barrier exists to direct the increase somewhere intentional before the spending finds it. The structural barrier is the automatic transfer set up on payday before the money is visible. It is the only tool that works at the level where lifestyle inflation actually operates, below the threshold of conscious choice, automatic and invisible, running before the upgrade presents itself. Rich habits versus smart habits. There is a meaningful difference between the habits of smart people and the habits of wealthy people, and they overlap less than you would expect. Smart habits optimize for understanding, reading widely, analyzing deeply, staying informed, forming nuanced opinions on complex systems. These are genuinely valuable. They produce capable, interesting, well-informed people. They do not reliably produce wealth. Wealthy habits optimize for consistency, the automatic transfer that runs before any other decision, the 401k contribution captured at every pay period without exception, the investment account that is funded first and ignored second, the lifestyle that is structured around what it costs rather than what it could cost if the income expanded to fill it. None of these habits require intelligence. They require setup, and then they require being left alone. The wealthiest people are not necessarily the most sophisticated investors. They are often the most boring ones. The person who bought a low-cost index fund at 25 and never touched it. The person who maxed their retirement contribution every year and never tried to time the market. The person who built an automated system and then spent their intelligence on everything except second-guessing it. Boring is the strategy. Intelligence keeps trying to improve on boring.
That tension is where most of the behavior gap lives.
The millionaire mindset is not a set of affirmations. It is not a morning routine or a vision board or a particular attitude toward abundance. It is a structural orientation, a default position the mind takes when it encounters money that prioritizes what an asset does over how an asset looks. The smart person looks at a raise and calculates what it could fund. The millionaire mindset looks at a raise and asks what it could become if it were never spent. The smart person looks at a car and evaluates its features and its value relative to the price. The millionaire mindset looks at a car and sees the monthly payment as a fixed outflow that will never compound into anything. The smart person understands the math of compound interest. The millionaire mindset feels the math of compound interest, and that feeling changes the decision before the justification can arrive. The shift from smart to wealthy is not an intellectual shift. It is a felt shift in what money means at the moment of decision, a shift from money as something to deploy in the present toward money as something to position for the future. And that shift cannot be read into existence. It has to be practiced repeatedly in ordinary moments where nobody is watching and nothing announces itself as the turning point. The knowledge was never the problem. The knowledge was always sufficient. What was missing was the practice, the quiet, unglamorous, unannounced decision made on a payday that nobody photographs, repeated until it runs on its own, building the thing that intelligence alone could only ever describe.